Welcome to the video on defined benefit pension plans presented by PAPE Canada. Now before we get started, I do want to announce a little disclaimer. This particular video and this particular topic, it's actually one of the more complicated ones to visualize, so you'll see me writing on the board a lot. At the same time, as much as the content is difficult for you who's listening, it's also a little challenging for me as well. So you might see me pause for just a moment. Of course, at the end of this, if you'd like to read up more on it, on our website we have some information, as well as the book Elmer's Nine and Dine is available on Amazon.ca for download or hard copy purchase. So let's get right into it. There are two types of pension plans. You have a defined contribution pension plan and you have a defined benefit pension plan. We're going to spend about 5% of the time discussing a DC and the rest discussing a DB. So we're all familiar, or more or less all familiar, with how an RSP plan works. You put in some money, it's there in the account, there's a tax deduction. It's up to 18% of your income combined between the employee and the employer deposits. A defined contribution pension plan, which are the most popular by far, they are pretty simple in terms of how they function and how they're structured. You put in a certain amount, your employer may or may not match those contributions. As an example, if you put in 6% of your salary as the employee, your employer might offer 3% or 6%, sometimes it's 9%, sometimes it's 12%. Depends on how many years of service, depends on your pension plan. Whatever goes in, that's the RSP deduction, or how much your unused room is going to be reduced by. It's much more simple to understand the defined contribution pension plan than the defined benefit. So as always, let's move over to what's the most difficult, because that's why we're here. The defined benefit pension plan is exactly that. We have defined the benefit. And by the way, we have defined the benefit in retirement. So unlike the defined contribution pension plan where we know how much is going in, we know how much is there, and of course, once you leave your employer, you can take out the money, or sometimes you can take it out while you're still working there. A defined benefit pension plan, you can't really get your hands on that money until either retirement or until you leave your employer. Now, because there have been some not so nice things happen in the past, there's also a lot of regulation around defined benefit pension plans. So as an example, if you're married and you're transferring the money out of the plan when you leave the plan and you want to invest it yourself in a locked-in retirement account, even though it's your money, this money is actually for the family, and so your spouse must also sign off that he or she is okay with doing the transfer. If you're not married, you still have to sign a form swearing and taking an oath that you are in fact not married. And the reason is because, a generation ago, 2 generations ago, when mainly men were out working in the workforce, women were not, there was, I guess, a husband who didn't want to be married anymore. So he took the whole commuted value when he retired, put it into an account, and he left. And he went to some other country. And now his spouse or ex-spouse who's never worked had no money. So all of a sudden, there was more regulation around the transfer of this. Now, for a lot of Canadians, all they know is, well, I have a pension, so I'm going to get paid later, I'm fine. Truth be told, a lot of people who today are majoring in, let's say, human resources or management, they don't fully understand how these pension plans are built, what it means to the employer, what it means to the employee. So we're going to run over a few different things today. The first thing is, what happens to your unused RSP room when a contribution is made for you, or when you're a member of a defined benefit pension plan? Well, when a plan is set up, somebody has to decide what kind of benefit are we going to pay out later, because we're defining the future annual benefit. And what was called a gold-plated pension plan was 2% of earnings every single year times the number of years of service. So what would happen is if somebody earned, let's say, $100,000, the future annual benefit would be $2,000 for every year that they worked. If they worked somewhere for 30 years and they were a member of the pension plan, they would get an annual retirement benefit of $60,000. If they worked there for 2 years, they get $4,000. Now here's the thing. Certain pension plans will pay 2%, some it's 1.75, 1.5. Some of them will say it's over your career earnings. Others will say it's over your best 5 years. It could be best 5 altogether, best 5 consecutive, or they might say forget the percentage times the amount. We're just going to pay you a standard amount of $1,200 and that's all there is to it. 3 types. Your career earnings on average, your best 3 years, 4 years, 5 years on average, they average it out, or a set amount. Those are the 3. Now, what reduces your RSP contribution room is going to be the future annual benefit, and there's a special formula for that. If you're there for 1 year, every year you get a tax slip for your RSP contributions, a defined benefit pension plan is no different. Your future annual benefit is calculated as 2% times your earnings. It's $2,000. So to figure out how much unused RSP room that you're going to lose, somebody somewhere had to establish a formula. And this is just the formula that's been established. If you're going to get into this and you're going to be knowledgeable in this area, you need to learn the formula. The formula is 9 times the future annual benefit minus $600. So remember, 2% times your annual salary that you've earned is $2,000. You will be paid $2,000 from the time you retire, we're going to call that age 65, until you pass away, we're going to call that age 90. That's the future annual benefit. And so it's 9 times 2,000, which is 18,000, minus 600 is equal to $17,400. That is your pension adjustment, which reduces your unused RSP room. Very quickly, if you were earning $100,000 a year, and you didn't have a defined benefit pension, you're allowed to contribute or deposit 18% up to a certain maximum into an RSP. 18% of $100,000 is $18,000. 9 times the future annual benefit is $18,000. Why is the 600 there? Well, I guess it's a buffer. We want to make sure that, given all the rules and regulations, and believe me, there's a lot of them, that what's been set up by the pension plan, which is a big undertaking, is not going to go over 18% of earned income, so they have a buffer. Okay? Now, this is what it means for the individual. I'm now going to flip it over and we're going to discuss what it means for the company and why certain workers that are a little bit older sometimes have a lot of difficulty finding new employment if the employer has a defined benefit pension plan. Now, I know you're not tuning in to these videos to hear my personal opinion, but I'll offer it to you anyways very quickly. I believe DB plans are a source of age discrimination, and if I had it my way and I was running the country, they simply wouldn't exist because they discriminate against older workers, and although I was a young man for many years, we only get older. We don't get any younger. So here's the thing. At age 65, that's when you're retiring. in our example, that's what I've decided. You retire at age 65, and because we're working with numbers, we need to have an end date. For men and women, there's like a 2 or 3 year age gap. It's 86 or 88 or 89 is life expectancy. We're going to use age 90. And so over those 25 years, the money inside of the pension is going to go from whatever it is down to nothing. And by the way, in this particular company, in our example, there are only 2 employees that work at this company. We have Gordon, who's age 60. Sorry about that. And we have, call it Mike, who's age 35. So, inside of the pension plan, the rate of return is going to be 8%. That's the rate of return. It's that amount every year, no matter what. It's linear, even though in real life it doesn't work like that. We have to anticipate something. We have to have an assumption. So it's always going to be 8%. We understand that every single year for 25 years, there's going to be a $2,000 payment made to both Gordon and Mike. Gordon is age 60, Mike is age 35, but they both earn $100,000 for the year. They do the same job, they earn the same salary, but one of them is a lot older than the other. So the first thing that we need to figure out, if I were a little bit taller, I'd stand in front and I'd block this particular portion so we can discuss the retirement years only. We need to figure out, if we're talking only about retirement, what is the present value of the $2,000 annual payment from age 65 till 90 to give somebody that annuity, the future annual benefit? How much has to be in the pension plan when that person retires to give them that amount? So we take our financial calculators. You don't have to have one, I've got it. And I'm going to make sure I got my payments per year set to 1. I understand there's 25 N's. I understand 8I/Y. We're looking for the present value. 2,000 is the payment. 0 is the future value. You can retire with nothing in the plan. We compute the present value. And that gets us to $21,350. So, for both Gordon and Mike, for 1 year of service, the employer has to put enough money in that by the time they retire, there's $21,350 at T is equal to 0, which, if you're talking about the retirement years, that's the present value. Here's the thing. If they're working there for 30 years, there's about $640,000 inside of that pension plan that has to be there to pay the $60,000 a year. That's a lot of money. So people ask, like, what happens if you have a lot of employees retiring the same year? Like, wouldn't you go broke? Well, yeah, if you had to deposit the entire amount for the employee's entire career, then yes. But that's not how it's done. On an annual basis, employers, the company, has to look at the totality of the individuals, of their employees, and put enough money in for that entire year for the $2,000 future annual benefit for everybody. That way the employees know that the money will be there in their pension when they retire. There have been too many instances where the government wasn't auditing these pensions closely enough, and all of a sudden, you know, you're 85 years old, you've been getting so much, we're going to cut that in half. We just don't have the money. And if you don't believe me, you can look at the Nortel Network's pension. It was cut and cut and cut. And a lot of people who had the promise of a high pension, they're not getting the money that they were promised. So, The question now becomes, if I'm the employer or if I'm in human resources and I need to make a decision, who am I going to hire? How much do I have to put in to get this amount later on? Well, again, if I was a bit taller, I'd stand here and I would block the retirement years, because now we're going to discuss the working years, because that's what we're dealing with. We have workers who we have this benefit, this pension for, that have to accumulate the $21,350 when they retire. As a result, what was the present value during the retirement years has become the future value during pre-retirement. So, this is now the future value of $21,350. So we know that Gordon's going to retire in 5 years. The $21,350 is now his future value. Annual payments will not be made. It has to be made in the current year, so we'll say 0 PMT. We know the return is 8% on the pension, and we have 5 years to get Gordon there. 5 is N. We want to compute the present value. So the employer must deposit $14,530 into the pension plan this year for Gordon, who's 60 years old. If you multiply 14,530 by 1.08, 1.08, 1.08, 1.08, 1.08, 5 times, you'll get 21,350. 21,350 minus 2,000 times 1.08 minus, keep doing it, you'll end up with 0. That's the whole point of what we're doing here. And so that's the cost of the defined benefit pension plan to the employer for Gordon, who's 60 years old. For Mike, who has 30 years, we're going to change N, we're going to make it equal to 30. We're going to compute the present value all over again. And for Mike, the employer only needs to deposit $2,122, I'm rounding again, for that to grow for 30 years at 8% to reach the $21,350. And so if you're an employer and you have to hire somebody and provide them a defined benefit pension plan, you have to make a decision. Do I want somebody younger, where the money's going to grow for a lot longer? Or do I want somebody older, where it's 6 or 7 times more costly, and I'm only going to have 5 years from them? And so the reality is that defined benefit pension plans, which were very, very popular in my grandparents' time, and very important because my grandfather worked for the same place for close to 40 years. You gave up your career, you spent all your working years with one employer. That was expected. You took care of your employer, and they took care of you. And he's been on pension for many years. Well, this is no longer the way things go today. It's normal to have, first of all, a longer working career today than in my grandparents' generation, because we're going to live longer. We're also probably going to have multiple employers, or we may have multiple different careers, okay? So it's important to understand what it is that you're looking at with a defined benefit pension plan. If you're the employer, you don't want to hire older people that are much more costly. You want to hire younger people because it's much less costly. Of course, at the very beginning, I put up the defined contribution pension plan. And if you'll go back to the beginning and you'll rewatch the video, you'll realize if somebody puts, 5% of their salary into the plan, well, the employer can just set it and say, whatever you put in, we'll match it. No matter how old you are, you make $100,000, you put in 5%, that's $5,000, we'll put in 5%. So there you go. On that, this is not an easy topic. In the next video, I'm going to discuss a pension adjustment reversal, a PAR for short. And I'm going to lead into it right away because a PAR is basically what happens when you leave before retirement. And it's a little bit more complicated, but I'm going to go into that video right away. So you can hold on and watch it there, or I can say thank you for listening, and we'll speak to you again soon.